Hi everyone, happy Diwali. So my Diwali decoration is still going on. Don't get distracted by that. We have a super important video. So let us kickstart, and in the recently concluded India-Pakistan match, you would have been seeing this ad where Mahendra Singh Dhoni and Sachin Tendulkar, they came together and started talking about mutual funds.
सिर्फ सेविंग्स नहीं, हर महीने म्यूचुअल फंड्स में भी इन्वेस्ट कीजिए,
वरना आपकी बेटी तो बड़ी होगी
पर उसके लिए सेव किए हुए पैसे शायद उतने ही रह जाएंगे.
Now comes the natural question that hey, why two legends are trying to convince the Indian market that go and invest your money in the mutual fund industry? You'll say that okay, a lot of money to be made for these cricketers, etc., etc. Partially agree, but here is a more prominent reason that in India right now, the penetration of mutual fund is one of the lowest across all the countries. So this industry is set to grow. You, me, everyone around us is going to take some exposure in the mutual fund industry in the coming days. And by having major ambassadors like Sachin Tendulkar and Mahendra Singh Dhoni coming together, this industry is set to grow in the coming years. So now comes the natural question that if we are anyways investing in mutual funds, then are there some schemes where we can actually save taxes by investing in mutual funds? So the answer turns out to be yes. How do you scout these mutual funds? They are called as ELSS, Equity Linked Savings Schemes. So on whatever platform you are investing, Zerodha, Grow, Upstocks, etc., you need to look for the word ELSS. So it would look something like this. So please go and check it. If that fund says ELSS, then you could consider taking some kind of position in those mutual funds in case you are deciding to avail some tax benefits. So what other tax benefits are there? Are there other instruments? For example, ULIPs. You might have heard that people invest in ULIPs in order to save taxes. Similarly, PPFs. People invest in PPFs in order to save taxes. So should we explore these options or should we go to ELSS? I will give you a very simplified understanding of differences, pros and cons of each of these options. And second, I'm going to help you pick 3 best mutual funds in the ELSS category. Now, this video has been not sponsored by any of the mutual fund houses. I'm giving a very independent review because this video is actually sponsored by TaxBuddy, which is a wonderful tax saving platform. In case you're looking to save taxes via mutual fund investing, via any other tax planning instrument, you can go and take help of TaxBuddy's team. They will help you optimize your taxes, file your taxes on return. It's a wonderful platform. You can check my link in the description box to avail a special discount. So let us kickstart our conversation and let us first and foremost understand the concept of 80C deduction. Now, what exactly is section 80C? Now, we don't need to become like CS. We just simply need to understand that in income tax, there is something called as section 80C, under which you can claim 1.5 lakh rupee from your total income as maximum deduction. So if you're going and investing in certain financial instruments, this could be your insurance, this could be your ULIPs, this could be your mutual funds, this could be your variety of different financial instruments. Under section 80C, if you are paying premium or making certain investments in these financial instruments, you can claim deductions up to 1.5 lakhs. So that is how you end up saving money. Now, people get very enticed that, okay, I will get to save 1.5 lakh rupees as taxes. So which instruments should I potentially look at? So people predominantly look at 3 different types of instruments. First is called as ULIPs, second is called as PPF, and third is called as ELSS. So let me quickly summarize what these things exactly mean and what are the pros and cons of going via any of these instruments. So let me help you very quickly understand in easy language what ULIPs exactly is. So here is a simplified definition of ULIPs. It says that it is a market-linked insurance scheme where the scheme invests in equity or debt-oriented schemes. Now, this one sentence is extremely complicated, it is extremely dense, and it becomes one of the prime reasons why people do not understand what they are getting into when they purchase ULIPs. So let me break it down. So first and foremost, ULIPs is a combination of insurance plus market-related investments. A ULIPs agent might come to you and say that, you know what, why are you wasting your money in terms of paying premium for your insurance? Why don't you invest that money in ULIPs? You will get some insurance benefit also. Plus, we will invest that money on your behalf in equity or debt instruments and you will keep on getting some returns. Now, this looks very enticing for people because they see that, you know what, insurance pay, why should we waste money? We will just go and rather use that money for investment. And this is one of the worst investment mistake you can make. Now, why am I saying it? Here is a snippet to prove it. This comes from Economic Times and this captures one of the commentaries of a person who purchased ULIPs. So he ended up saying that I purchased my first policy in the year 2000 and he was 29 years old and added 4 more plans as his income grew in the following years. He used to pour in 1.5 lakh rupees in terms of the premiums that he was paying for this ULIPs plan. And he saw a lot of investment option pass by because majority of his money was being tied into ULIPs. Now, why am I speaking negatively about ULIPs? So I would encourage you to go on Google and type out why you should not be purchasing ULIPs. But let me summarize 2 points by this flowchart. So the first key problem with ULIPs is that people do not understand what they are buying. For example, they believe that they are buying some kind of insurance, because ULIPs has an insurance component to it. But they do not understand what type of insurance they are getting into. Insurance buying in itself is a very complicated game, and that is one of the prime reasons why ULIP is criticized, because they sell a type of insurance which might or might not suit your needs. So this is the first key problem with ULIPs. Now here your money can go into equity, which means stocks, right? For example, if you're buying Bajaj Finance, HDFC, all these are what? These are stocks. Debt means bond market. For example, if you are buying the corporate debt of HDFC or corporate debt of ITC, that is the debt part of it. Now you don't know as an investor where your money is going, and it has been proven through extensive market research that ULIPs end up giving really poor return on this side of the equation. Now, third and final problem that I have with ULIPs plan is fairly simple, that you do not understand how much commissions you are exactly paying. For example, take a look at this chart. This is based on 50,000 rupee premium that a person is paying, and here are the computations that are done. Now, after all this research came out, a single figure stood out that a person was paying approximately 7% as intermediary charges on ULIPs. So these are very, very high commissions. Just to tell you about the context, that if you are investing in mutual funds, even the worst of the worst mutual funds, you would not end up paying more than 3% commissions. So these are some of the stated problems with ULIPs. Why have I stressed so much about it? Very simple, because a research was done and it was proven that approximately 66% of Indians would love to buy ULIPs. Now this is something which is deeply worrying, because ULIPs are probably the worst option in which you can invest your money. Now comes the second option, which is the PPF. Now what is exactly meant by PPF? How much return you can expect, etc., etc. Let us have a very quick conversation there. Now PPF is nothing but an account that is managed by the government. Now your employer or you keep on putting money month after month into this PPF amount, and the government takes that money and goes and invests it in the market. What are they doing at the back end? Let me quickly explain that. So here is a very quick chart. You can see that the current rate of interest offered on PPF account is roughly 7.1. Now this keeps on going between 7 and 8%. So this is a flexible figure, but let's assume 8%. Now the benefit is that this return is guaranteed, that the government says that whatever money you have stuck into your PPF account, the maturity period is 15 years, and the government is going to pay you an 8% rate on that PPF amount. You can do very little investments and you will be able to claim tax benefits up to 1.5 lakhs. So what is the advantage? The advantage is that you get guaranteed return of 8%. What is the disadvantage? The major disadvantage is that your lock-in period is roughly 15 years and you're only getting paid 8% returns, which is a really, really bad return over a 15-year timeline. So comes the natural response that, okay, why is it that the returns are guaranteed? And second is that why am I getting so low returns? The reason is that at the back end, PPF investment is done into debt instruments. Debt means bonds. So the bonds are purchased and the returns are therefore risk-free. But the primary issue here remains that if you're locking your money for a 15-year time period, then go and lock it in Nifty 50. Again, the returns are almost guaranteed. They are volatile returns, but over the last 20-year period, the average returns has been 12.5%. And it is highly, highly, highly improbable that Nifty will start giving like 8%, 9% return from 12.5% return. In fact, these returns due to excess money printing is going to improve with time. If you want, I'll make a separate video on that. But if you have to choose between PPF and other market instruments, for example, mutual funds or index funds, then my advice would be that you should go with mutual funds or index fund route. That is much better from an overall return on risk perspective. Now you might have a natural question that, Akshat, then why is it that people invest such crazy amount of money in PPF? Well, a few years ago, there used to be more tax benefits associated with PPF. For example, whatever capital gains you were making on your PPF account, on that you didn't have to pay taxes. Now the rules have changed and they are treated exactly like ELSS funds. So what are ELSS? Let me quickly explain that. And let me also prove with data as to why ELSS is much better compared to PPF. Now, if you take a look at the mutual fund universe, then there are 1,000 different types of mutual funds, right? For example, if you take a look at index fund, now what is index? In index, you will have Nifty 50, you will have index Nifty Next 50, you will have Dunia Bhar ke index funds also. So those are a type of mutual funds. Then comes ELSS. So these are tax saving instruments. Here, the condition is that you have to lock in your money for a 3-year period. This is the first key point. Second, your money gets invested where? It gets invested in stocks. Because the full form of ELSS is Equity Linked Savings Scheme. So what is the meaning of equity? Equity means something like HDFC Bank's stock, something like HUL's stock. So what is stock? Stock is basically equity. Equity and stocks are interchangeable words. And here your money is getting invested for 3 years and it is getting invested in stocks. So with that said, let me now show you 2 data points to prove why ELSS is a much better scheme compared to PPFs. Now again, there are 100 different types of ELSS, but if you consider the performance or overall performance of ELSS, you will see that during this phase, or this must be like around 2015 to almost 2020, 100% of ELSS were outperforming PPFs. Then in 2020, market crashed. The market of course crashed. Then also almost 75% of ELSS were outperforming PPF. And this number went up. And now again, almost 100% of ELSS are outperforming PPFs. So now comes the natural question that, okay, fine. Yes, ELSS are performing better than PPF, but by how much are they performing better? Okay, so for this, take a look at this chart. And this difference or this consistent difference indicates the range of outperformance. And this usually would come out to be between 5 to 7%. So this is the number that you need to be aware of. Now, again, in summary, in terms of PPF and ELSS, the tax benefits are the same. So now comes the final part of the video that, okay, great, ELSS, probably the best option for me. So which ELSS funds could I buy in order to save taxes? Now, this is my personal view. I will share a range of options with you. You pick whatever options feel best to you. I'm not ranking these mutual funds as 1, 2, 3, 4. Whichever 4 or 5 mutual funds I'll be speaking about, they are all good because they have consistently beaten the market. So I will speak with data there. And again, please go and speak with Tax Buddy team. In addition to helping you save taxes on mutual funds, they can help you save taxes by doing proper tax planning. So with that said, let me quickly speak about 3 or 4 key ELSS based mutual funds. So the first fund that I would like to speak about is called as Access Long-Term Equity Fund. And why am I saying that this is a decent mutual fund? Simply because of this graphic, that if you check the last 10-year performance of this fund from 2013, it has consistently beaten the market or the index. Which index are we talking about? We are talking about the total market cap of the Indian market, which is S&P 500 BSE. So that is the index against which we are comparing this. So this is an overall wide index, which this mutual fund has been able to beat consistently. So this is the first good point about this mutual fund. Second key point about this mutual fund is the expense ratio, that the expense ratio is 0.77, which is not very, very aggressive. Again, you can check the tag that you will get tax benefit. It is called as ELSS. Final point is regarding the portfolio, that I feel that this is a slightly aggressive portfolio as of now, and which is a good thing because the markets are down. So whenever the markets expand from this point, such a mutual fund is likely to give even better returns. So with that said, let me quickly share the portfolio viewpoint of this mutual fund, and you can scroll all the way down to see the allocation, that what type of companies is this fund buying. So right now they have huge exposure to Bajaj Finance, Avenue, Supermart, DMart, Kotak Mahindra Bank. A lot of money is in top 10 stocks. So this is a highly concentrated portfolio. Now, just to talk about the sector allocation, you can see that approximately 25% of sector allocation is in finance, but this is a well-balanced portfolio. So if you don't know much about individual stock picking, so this becomes one of the good mutual funds in which you could consider taking some positions in. Now, with that said, let us move on to fund number 2. And here I would like to share 2 options with you. So one is called as IDFC Tax Advantage ELSS Fund. Again, this fund has consistently beaten the index, which is the good point, and that is one of the key reasons why I have picked this fund. The second key point that you need to know is the portfolio allocation. So this is a slightly more diversified fund compared to the first one. So here you can see that it has high exposure to finance, but all the other sectors have very low exposure. So this is a much more diversified fund. So if you are looking to lower your risk, then this fund is better than fund number 1, which was from Access. So you make the call, whichever fund makes best sense for you. In case you want to check their entire portfolio, here is the entire portfolio. Overall, the list of the stocks looks solid and they are not overexposed to any of the stocks. The first fund was slightly more aggressive in nature. Right now, buying something like Access might make more sense because the markets are down and they will recover. But when the markets are somewhat stable, buying a fund like this, IDFC one, might make more sense. Now, another similar option here would be by Mira Group, which is Mira Asset Tax Saver Fund. This is again a decent fund, very, very similar to the fund that I just discussed from IDFC. So whichever fund house you have more trust in, you can go with that. Here again, the allocation is somewhat similar, that this is a diversified portfolio, not a concentrated portfolio. And again, here they have a lot of exposure to banks and rest of the companies have little exposure. So this meets exactly the same roadmap. So go and check wherever the expense ratio is low. Go with that. That's what I would say. So let's move on to the third and final fund, and the name is DSP Tax Saver Fund Direct Plan. And okay, one very quick note. Please only buy the direct plans, not the regular, because this way you save on commissions. This fund has actively beaten the market and has also given you tax reward, so to say. So this is a good fund. Therefore, I have picked it in the list. Now, just to talk about the sector allocation of the fund. So this is again a concentrated portfolio, majority of it being in tech and finance. Other than that, very little exposure to other sectors. So this is comparable to the Access fund that I was telling you about, that portfolio was also very concentrated and this portfolio is also very concentrated. So these type of funds are likely to do well as of now, but once the market stabilizes, these funds might not do so well. So it might make little bit more sense to buy these funds now and sell it off when the market aggressively grows, and then rotate it to slightly more diversified portfolio. So just to give you a very quick walkthrough of what type of stocks do I like versus not like from this. Again, HDFC Bank would be one of my favorite stocks. ICICI is a good stock. Infosys, Axis Bank, SBI, all are fine. There is no major problem. A stock that I do not like from this list is Bharti Airtel. I'm not too bullish, and neither do I like HCL Tech. So these are two stocks that I personally do not like, but overall their exposure to these two stocks is very, very limited. So this seems like a good option. But I hope through this video you learned that you should not be investing your money in ULIPs. You should also not take too much exposure in PPFs. In case you do not know much about stock investing, mutual fund investing, go with ELSS schemes. Not a problem there. Expense ratio is also fine. I have already given you a viewpoint as to which ELSS options you can execute. In case you want to figure out more options, go and check the expense ratio, figure out how concentrated or diversified the portfolio is, and accordingly make an investment call. And please do not forget that when you are investing either in PPF, ULIPs or ELSS, you are putting your money for a slightly long-term period, minimum 3 years. So with that viewpoint, start investing and I'll see you soon.